what got us here? Show us the chart.
Well, obviously, we had a pretty big break in the market, which was pretty disappointing. I think the starting point here is we had a big break of the 50-day this week, and now the market's challenging the 200-day, which I think have people pretty concerned. But there's a couple of points we're going to have to look at that I think argues that the market is setting up for at least a short-term bounce from current levels. Yes, the 200-day is broken. When you look at it on the futures, it's sort of hovering right around that level. And even though you can't see it clearly on this chart, you're right at that 50% level of that biggest move. So you've retraced half of what we've had all the way through 2018. And I think we're going to get a bounce here. Expect more chop going into the weekend and a little bit more upside as we come out of that. We're going into option expiry. You often see lifts around that time. And for what it's worth, this RSI indicator is pretty deeply oversold. There should be a recovery bounce developing in the next couple of days. If we take a look at the next chart. And what I think is important going forwards is this relationship between growth and value. It's a hot spot people have been talking about. The founder of Fundstrat made a big point about how value tends to outperform when rates are moving higher. This is critical. This long-term trend began at the beginning of 17, and it's challenging it right now. It hasn't broken. And the move that we had in the last couple of days, or actually today specifically, a lot of these growth stocks are starting to bounce back. Software names coming off the 200-day. What I think is critical, it's got to hold that summer trading range low. We're going to give it a little room. It's an important relationship. My guess, my view here is that we're going to get more upside going into the end of the year. But as we move into next year, that's when it's going to be a hot spot.
And that would help the overall market bounce back because growth seems to be the bigger driver of the...
I would think so. I mean, there's some very big cap names. They are certainly extended. They've had a big run. It's not as though there's not a lot of risk in these names, but I think investors are going to go back to the names that they know and trust, and that's going to be key. We break that relationship, I think the market's in trouble.
Todd, what about you?
Absolutely. I think to start, you asked the question at the top, why are we here? And I'd really just like to look at a big picture chart of the yields of bonds, in fact. And if you ask somebody at a cocktail party, what's a traditional relationship between stocks and bonds, what do you think they would say?
They go in opposite directions?
They go in opposite directions. But I look at this chart and I say, boy, the price of the bond in stocks looks like they go in the same direction, in fact. So if you look at this, I mean, this is a direct relationship. The problem that you're seeing is we're starting to see a little divergence, number one. And number two, if you were to draw a trend line from 1978 to where we are now, if you were to really hone in on this right here, we've broken uptrend support. That's 4 decades of downtrending yields that just changed. This could be a paradigm generational shift in yields, and can stocks handle that?
Todd, do you think there's a longer-term shift that develops at a certain level for bond yields? Does it have to get above 4.5%, 5%? Is that where it gets markets start to get uncomfortable with it?
For technicians, the damage is done.
Got it.
We just broke 38-year trend in downtrending yields. I'm not going to extrapolate what that means, but support is broken.
On a 30-year or on a
30-year, exactly. 30-year yield. And the important thing, Rob would agree with this, this is a semi-log chart. If you're going on CNBC.com and you're looking at your charts, make sure you're looking at semi-log, which puts percent change compared to other percent change. So if you hopefully that makes sense. Any
thoughts on the 10-year? Do you think the 10-year is broken yet? Are we getting close? Any thoughts whether it pulls back? Or
the shorter the duration, the earlier they broke trend. I mean, obviously we know the 2s are just in a straight downtrend. So yeah, this is a serious problem. And I think as you shift it over to the S&P, I'll pick up where you left off on the S&P. We should see a nice uptrend support here. But again, we just broke support on the S&P. And if you were to look at a bar chart, that's how us traders will look. We've just closed below it. The other point, we're talking about the small caps. If you look at the S&P compared to the small caps, this is S&P divided into small caps. We've also begun to break through, which means the S&P is outperforming the Russell. Said differently, small caps underperforming the S&P. For me, at significant market turning points, I see those small caps lead, and it's happening again. I'm concerned.